Welcome back everyone to another dividend portfolio update. If you're new here, on this channel I do weekly update videos going over my dividend portfolio after my weekly deposits. So let's jump right into what I bought and how my portfolio did this week. So we're up to $22,341 as you can probably tell by the title, which is up $360, up about 2%. This week we've got several buys. So everything from here up was bought from the last video. We've got $6.44 from Clorox, $7.93 from AbbVie, $5.46 from Colgate, $5.57 from Procter & Gamble, $3.56 from Realty Income, and $6.42 from Texas Instruments. Guys, our dividend payouts are definitely starting to get bigger. All those together this time equaled $29.04 across 3 buys. We put $7.99 in Verizon, $3.75 in Johnson & Johnson, and $17.30 in Home Depot, equaling the $29.04. Then I added another $250 this week for my weekly deposit. That was spread across 12 buys. It actually looks like the Texas Instrument dividend was paid out the 16th, and that's why I have $256 deposited, so the 6 carried over to this buy. So we put $256 across 12 buys. I'm just going to round here. We put $38 in AbbVie, $13 in Union Pacific, $7 in Walgreens, $18 in Coca-Cola, $20 in SPHD, $15 in Air Products, $28 in AT&T, $30 in Realty Income, $17 in Altria, $9.50 in SCHD, $36 in Verizon, and the last $24.50 in Johnson & Johnson, spreading our $256 across 12 buys. So jumping over to our dividend tracker, we can see we're up to $815.95 of annual dividend income if I don't add another dollar. But I deposit more every week, so you know that number will keep going up. We're projected to make $81.89 in May so far. And look at that, guys, the yield on cost is steadily going up. Every time we add these shares, penny by penny, dollar by dollar, as they're going down, the yield will keep going up and we'll be able to lock that in for the long haul. Now coming down here, if we want to sort by P&L, we can see obviously Broadcom's doing our best, up 14+%. Then Kimberly-Clark up 13%. General Mills up 14%. Hello? I'm not sure what... Alright, this thing is broken. Either way, we've got Pepsi up 11%. We've got McDonald's up 11%. Our worst performers, we've got AT&T down 12%, Walgreens down 11%, Realty Income down 7.5%, Target down 7.5%, and Verizon down about 7%. They're balancing each other out though. Look, there's more green than red, and that's why our portfolio is green. Alright, now it's time to get into what all you guys have been waiting for based on the title. My new stock pick I'm thinking about buying is Whirlpool. I heard about it on CNBC from Jenny Harrington. I actually am going to roll the clip because I think she summed it up perfectly for you guys.
So I think it was interesting. Do you remember about a month ago, Goldman upgraded Whirlpool and I had a small meltdown because I said, I've been working on this, I've been so close to buying it. They put out a really compelling bull case on it. But so what you have for both of these actually is a similar investment backdrop where they've got easing supply chain issues, they've got freight costs coming down, inventories have been worked out, but most importantly, the share prices have dramatically corrected. Whirlpool's down 50% from its all-time high, which was in 2021. Stanley's down 62%. So you have this company, Whirlpool specifically, where they're going to earn about $16 a share this year. They've got a 5.4% dividend yield, and the shares are trading at the same price they were at in 2013 when they were only earning $10 a share. And this really speaks to the market, right? It is a mixed up, bifurcated market where within sectors, within strategies, different stocks, everything's moving differently. And I don't want to buy something. I'm much more comfortable buying this at 8 times, you know, with this big yield and this low valuation, earnings growth ahead as things normalize, than I am buying something that's already up a lot.
And to reiterate some of her points, it's a dividend aristocrat paying a 5.4% yield, down over 50% from its all-time highs. It's currently at 8 times the earnings, and there's solid demand no matter what type of economy we're in, being home appliances.
You're comfortable buying something where big ticket item demand remains, I think, a serious question, and we've heard it from CEOs who are selling big ticket items.
So I think in this space, it's a little different because there's a less discretionary component to if your dishwasher breaks, your washing machine breaks, you have to buy that. So that's different than like kicking the can down the road, or rather saying like, hey, I just want a new car because I want a new car. People don't go out and they're like, hey, I just want a new dishwasher. That'll be fun. So there's a different element to discretionary on Whirlpool than there is otherwise. The other thing is they had this earnings call, and what you really saw in the earnings call is that demand is stabilizing. It's getting back to normal, where it's not through the roof. And it was wild during the pandemic when you saw the share price just shoot up because it was like, oh, everyone's going to own a home. Everyone's going to need a new washer. That was irrational.
The downside is, and one of the main reasons I have not bought it, is today is the X date, which is the date where if you buy the stock after this date, you don't receive the dividend for this current quarter. So you would hold it for 3 months and not get a dividend. Just something to think about. So I will be keeping my eye on Whirlpool. I'm looking into some other stocks as well. I may go ahead and buy it. I may decide to wait because of not being able to get the dividend this quarter. But it does look like it will have some appreciation. So it's definitely on a person-to-person decision. Anyways, that wraps up today's video. I hope you guys enjoyed it. If you did, hit the subscribe button if you haven't already. Smash the like button. It really helps out with the YouTube algorithm. And until next Friday, have a great week. Peace.